Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, August 12th, 2025. Hope everyone's having a great week. So as always, we'll start with the executive summary from today's leadoff morning note. If you want to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, or to get on the right side of market risk to the extent you haven't been following KISS or Dr. Mo, you need to be a client of 42 Macro. So today's key macro question is, how are tariffs impacting the U.S. economy thus far? Our answer? Generally in line with our expectations, which have called for growth to generally and persistently surprise to the upside, and for inflation to be generally reported in line with consensus, which is precisely what occurred across both headline and core CPI in July. Regarding inflation specifically, the July CPI data generally supported our sticky inflation theme. Regarding tariffs, core goods CPI, the most impacted category, added 4 basis points and 24 basis points to month-over-month and year-over-year headline CPI, respectively. These figures represented the highest contribution since February 2025 and June 2023, respectively. The good news is that small business confidence improved and beat consensus expectations amid clear evidence that inflation statistics are already being flattered by the one-time price adjustment from tariffs. Specifically, the July NFIB Small Business Optimism Index generally supported our resilient U.S. economy theme. It is likely that the reduction of fiscal, regulatory, and trade policy uncertainty is at least a positive offset to the headwind from rising tariff rates. All told, investors would be remiss to assume our U-shaped economy thesis is now void after one soft data point. The U-shaped economy affords the Fed a window in which to ease monetary policy to offset the advent of higher tariffs. Monetary easing can also be a tailwind to offset persistent trade policy uncertainty, something the Trump administration has applied effectively to extract meaningful concessions from key trading partners. There simply must be more coordination between the monetary and fiscal authorities to guide the U.S. economy through the worst of the U-shaped economy. Recall that we have carefully outlined the structural reasons why the Fed's reaction function regarding inflation must change before the Powell Fed causes a recession that materially erodes the U.S.'s fiscal health. If the Fed does not heed our warning, the result will be a guaranteed erosion of U.S. central bank independence because the Fed is the only institution in the world with a balance sheet large and flexible enough to fill the fourth turning size demand hole in the U.S. Treasury bond market. For what it's worth, this outcome is a high probability anyway in the context of the geopolitically driven supply-demand imbalance in the Treasury bond market, which we identified years ago in the context of our exceptionally accurate and highly lucrative investing during a fourth turning regime framework. The eventual erosion of Fed independence will simply occur much faster if the Powell Fed pushes the economy into a recession by not supplying the monetary policy support required to offset the advent of Trump's tariff regime. Team 42 may continue to trust KISS and Dr. Mo to safeguard their families and or their clients' families' purchasing power from these risks. Transitioning to our 42 Macro dashboard, as always, we'll wrap up the question from our community. These aren't questions, but rather they're comments, and they really jive with what I just said with regards to our clients being able to trust that KISS and or Dr. Mo they can trust those risk management overlays to safeguard their families' purchasing power from the risk of financial repression, monetary debasement, and all the types of things you tend to see in a fourth turning regime. So without further ado, let me review these comments. So the first one says, I listened to the August 7th Macro Minute late last night while working at my second job. As you read Shoji's post, I was thinking, damn, that's me. Wife and I have worked hard while living a simple life, scratched, clawed, and saved a decent little nest egg. For years, we've had it all in short-term T-bills, afraid to put our hard-earned money at risk in the quote-unquote stock market casino. At age 53, we realized that simply saving T-bills ain't going to cut it. Increasing prices and inflation have us slowly losing ground. We finally paid for the KISS research access after following you for years, and we're slowly allocating our capital to the pie chart. I want to thank you for speaking out and looking out for little folks like us, Darius. I just want to say thank you, appreciate you. And then the second comment says, thanks for your response to my post-Fed chair TD. It's a little premature, but it goes on to read, I think there are a lot of I think there are a lot of these people out there in terms of being in short-term bonds with no trust in the broader financial system. And this person is that. So let me just pause there and just say, one, thank you guys for the kind feedback. This is exactly why we built our firm, is to help everybody across the world and across the investing spectrum, participate in financial markets with enough confidence for a long enough period of time to retire on time and comfortably. And one of the things we identified, and this is, I don't think we're breaking ground here, but I think it's pretty clear that we've been in an era of, persistent financial repression and monetary debasement since this fourth turning was catalyzed back in 2008 with the GFC. In our view, those dynamics are likely to get worse over time before they start to get better. And so if you're someone who has been burned by the legacy of the GFC, or the legacy of the dot-com bubble, or maybe even 1987, the legacy of these big shocking left tail risks that have caused you to not have the kind of confidence and trust in broader financial markets that you need to retire on time and comfortably, especially in an era of persistent monetary debasement and financial repression, whereby your purchasing power is being eroded by what perhaps is very lowly reported or underreported inflation statistics. You just can't sit there, in T-bills. You can T-bill and chill, but I guarantee you will not retire on time and comfortably if that is your asset allocation mix. You're more likely to retire late and poor if that is your asset allocation mix. So if your goal is to retire late, if at all, and poor, then hang out in T-bills. If your goal is to retire on time and comfortably, then obviously KISS is a phenomenal solution. In my opinion, I think it's the world's best solution for that particular, to achieve that objective. I'm not at all purporting that KISS is perfectly suitable for every investor. That's not what we do here. All of our research is general in nature. But to the extent that you don't have enough confidence to take the leap from T-bills to KISS, then do it piecemeal. You don't have to put 100% of your portfolio in KISS. You can put, X percentage of your portfolio in KISS and leave the rest in T-bills, and dial that appropriately over time as you gain more and more confidence, not only in the financial system, but more specifically in the confidence in, the quality of the risk management overlays, the quantitative risk management overlays that we built to guide the KISS system and to guide the Dr. Mo systems for our clients. That's one solution is, doing a little bit of KISS, a little bit more KISS at a time, so you get enough confidence to do all of KISS. Or another solution that many of our clients, and again, we have thousands of clients around the world in 80 plus countries. Many of our clients have also elected to implement customized versions of KISS, whereby, let's say, they don't want 60, 30, 10 stocks, gold, Bitcoin, which is what KISS is when it's maxed out and there's no cash. Maybe they want, more or less stocks. Maybe they want, low beta stocks instead of, the stock market, or higher beta stocks based on where they are in their retirement journey. Maybe they, instead of want gold, they actually do want T-bills, or they want some yield because they're a little bit further along or into their retirement journey. Maybe they don't like Bitcoin. Maybe they want Ethereum, or maybe they just want a little bit less beta in the portfolio. So maybe they go stocks, T-bills, gold, as opposed to stocks, gold, Bitcoin, which I think is a much more suitable asset allocation for surviving in a fourth turning regime with more money and more purchasing power than you would at the start of that regime. So, like I said, there's multiple ways in which you can use the high quality, risk management overlays that we built here at 42 Macro to achieve your strategic investment objectives. You don't necessarily have to blindly follow KISS with your entire portfolio. Again, like I said, you can rotate into KISS and balance that out with a more safe asset allocation mix, quote unquote safe. I think, in my opinion, and again, this is my highly informed opinion as someone who produces hundreds of slides of research every single week. Every single 52 weeks a year, I produce hundreds of slides of research for our clients. And as someone who produces probably more research as a single individual as anybody on Global Wall Street, I can tell you right now, the risk asset is the T-bills. You're losing money by being on T-bills on a real basis. The risk asset is the treasury bond market in a fourth turning. If you want to allocate to the melting ice cube that's causing all the rest of the assets to skyrocket in price because of it being a melting ice cube, then yeah, stay in that asset class. If you want to retire on time and comfortably, and more importantly, do so while being able to sleep at night from a reduction in stress perspective, then that's what we built KISS for. And we also built Dr. Mo. We built Dr. Mo for institutional investors, but retail investors can use Dr. Mo to implement a customized version of KISS that's more, quote unquote, suitable for their strategic investment objectives or their risk tolerance than our standard KISS portfolio. So a lot of ways to win inside of our paywall. If you want to retire late and poor, if at all, stay outside of our paywall and keep doing what you're doing. There's a lot of ways to retire on time and comfortably in our paywall. That's why we built our firm, and that's why we have some of the best testimonials of any business across industries in the world with one of the lowest attrition rates. in the world, and we're super proud of both of those statistics. I think our attrition rate is like in the low threes. It's lower than Apple. Apple has a lower attrition rate than 42 Macro. And by the way, 100% of our customers can cancel at any time without penalty. 100%. Right now, all of our customers can retire, or can not retire, can cancel right now. All 100% of them without any penalties, lockups, delays. That's it. And we have a lower attrition rate than Apple. So what does that tell you about what's happening on the inside of our payroll? I'll leave you with that. Have a great day. Cheers.